On October 16, 2001, a number appeared that should not have existed. Enron announced a $618 million loss. By itself, that wasn't unusual for a corporation of its size. It wasn't even catastrophic, but something didn't match the story people had been told. Just weeks earlier, the company had reported strong earnings. Analysts were still calling it one of the smartest businesses in America. Pension funds were still treating it as a safe growth stock. Employees were still buying shares, many using their entire retirement accounts. And yet, in a single disclosure, over $1 billion in shareholder equity quietly disappeared. No factories burned. No pipelines exploded. No external shock hit the market. Only the numbers changed, and they changed fast. If you were an employee in Houston that morning, nothing looked broken. Elevators worked. Coffee machines hummed. The stock ticker still updated in the lobby like it always had. But inside those numbers, something fundamental had already collapsed. Within 30 days, the stock would fall from over $30 to under $1. Within 60 days, one of the largest corporations in America would file for bankruptcy. And when investigators finally pulled the records apart, they found something far more dangerous than a bad investment. Enron had been reporting profits that were never actually earned. Not simply exaggerated, not just pulled forward. They were calculated from deals that would take 10, 15, even 20 years to play out, and then recorded immediately as if the cash had already arrived. At the same time, the losses were quietly moved elsewhere, buried inside entities that did not officially belong to Enron at all. The system didn't fail overnight. It was rewritten slowly, line by line, until reality itself no longer had a place on the balance sheet. And almost no one noticed, until the cash stopped coming in. Before Enron became a scandal, it was a story Wall Street loved. In the early 1990s, Enron was not a fraud. It was a pipeline company. Boring, predictable, limited, it moved natural gas from one place to another and earned steady, unremarkable fees. Then came deregulation. Energy markets in the United States began to open. Prices were no longer fixed. Contracts could be traded. Risk could be priced. And Enron saw something others didn't. It stopped thinking like a utility and started thinking like a trading firm. Instead of simply transporting gas, Enron began trading contracts on future energy prices. It became a middleman, matching buyers and sellers, taking a spread on every deal. At first, this looked like innovation. Revenue exploded. By the late 1990s, Enron reported a 750% increase in revenue. It expanded beyond gas into electricity, broadband, even weather derivatives, financial bets on temperature itself. To the outside world, this looked like intelligence. Complexity became a signal of sophistication. But complexity has a side effect. It becomes harder to verify. Inside Enron, a new idea took hold. If you are signing long-term contracts 10, 15, 20 years into the future, why wait to recognize the profit? Why not calculate the total expected profit today and record it immediately? This was not illegal. It was called mark-to-market accounting. Under this method, when Enron signed a long-term deal, it would estimate all future profits using internal models' assumptions about prices, demand, interest rates, and then book that entire profit on day one, not when the cash arrived, not when the service was delivered, but when the contract was signed. On paper, this created something extraordinary. Every new deal instantly generated profit. Earnings appeared smooth, predictable, and constantly growing. But there was a hidden condition. Those profits depended entirely on assumptions about the future assumptions that only Enron controlled. If those assumptions were even slightly wrong, the profits weren't just delayed. They never existed in the first place. And this is where the trap quietly formed. Because once you recognize profit today that won't materialize for 15 years, you inherit a new problem. You must keep making new deals just to maintain the illusion that the old ones are still working. The machine cannot slow down. It must feed itself. And when reality begins to diverge from those early assumptions, the gap doesn't appear immediately in earnings. It appears somewhere else, somewhere harder to see. That is where the shell companies enter the story. Quick question. If someone promises to pay you $1 million in the year 2045, are you a millionaire today? Most people would say no. Because the money isn't in your account. It's a possibility, not a reality. Enron answered that question differently. Inside its accounting system, that future promise could be turned into profit immediately discounted, modeled, adjusted, and then reported as if it had already been earned. This is the core of mark-to-market accounting. In its simplest form, the method makes sense. Traders use it every day. If you hold an asset that has a clear market price, like a stock, you can mark its value based on what someone would pay for it right now. But Enron wasn't dealing with simple liquid assets. It was dealing with long-term, highly complex contracts, custom energy agreements, infrastructure deals, broadband capacity projections. There was no real market price. So Enron created one. Imagine this. Enron signs a 20-year contract to supply electricity to a city. The total expected profit over those 20 years might be, say, $200 million. Instead of recognizing that profit gradually as electricity is delivered and cash is received, Enron would estimate the entire future cash flow, apply its own assumptions about prices and risk, and then record a large portion of that $200 million immediately. Day 1. The moment the contract is signed, the income statement shows a surge in profit. But here's the tension. No cash has actually arrived. What exists is a model, a projection, a belief about the future. Now imagine you are an executive inside Enron. Your bonuses depend on reported earnings. Wall Street rewards consistent growth. The stock price rises when profits look smooth and predictable. You now have an incentive not just to close deals, but to structure them in ways that maximize day one profit, even if the long-term reality is uncertain, and if reality later contradicts your assumptions, if prices move the wrong way, if demand falls short, if the contract becomes less profitable than expected, you're supposed to go back and adjust the value downward. That adjustment is called a write-down. But write-downs destroy the illusion. They create volatility. They expose that earlier profits were overstated. They trigger questions. So instead of correcting the past, Enron did something else. It moved the problem. Losses that should have appeared on Enron's income statement were transferred into separate entities that looked independent on paper, but were quietly controlled from the inside. These were the special purpose entities, or SPs. Here is how the mechanism worked in practice. Enron would take an underperforming asset, a deal that was no longer producing the expected profit, and sell it to an SPE. In return, Enron would receive cash or a promise of payment, which allowed it to avoid recognizing a loss. On the surface, it looked like a legitimate transaction, but the critical detail was hidden in the structure. Many of these SPs were financed using Enron's own stock as collateral. Their ability to pay depended on Enron's share price staying high, and the people managing them. In several cases, they were not independent outsiders. They were insiders, most notably the company's own chief financial officer. This created a closed loop. Enron's reported profits kept the stock price elevated. The elevated stock price kept the SPs solvent. The SPEs absorbed the losses that would have reduced those profits. As long as the stock price held, the system appeared stable. But underneath, the gap between reported profit and actual cash kept widening. Imagine you are a mid-level employee in 1999. Your retirement account is filled with Enron stock. Your company reports record earnings quarter after quarter. The narrative is consistent: innovation, growth, dominance. But if you looked at one specific line in the financial statements, one line that rarely makes headlines, you would see something unusual. Cash flow from operations was not keeping up with reported earnings. In simple terms, the company was saying it was making money, but the cash wasn't showing up at the same rate. That gap is where the truth lives, because profits can be modeled. They can be accelerated, deferred, reinterpreted, but cash is binary. It either arrives or it doesn't, and by the time that gap becomes too large to ignore, the system has already reached its breaking point. The system didn't collapse when the deals went bad. It collapsed when the stock cooperating. By mid-2001, cracks were already forming beneath the surface. Some of Enron's largest positions were no longer performing as modeled. Energy prices had shifted. Broadband bets were failing. The assumptions that once justified early profits were no longer holding. Under normal accounting, this would trigger write-downs. Losses would surface. Earnings would fall, the market would adjust. But Enron couldn't afford that sequence, because its entire structure depended on one fragile condition: a high and stable stock price. The special purpose entities, the vehicles absorbing Enron's hidden losses, were propped up using Enron shares as collateral. As long as the stock stayed elevated, the illusion held. Then the stock began to fall. Not dramatically at first, just enough to strain the system. And that's when the loop reversed. As Enron's share price declined, the collateral inside the SPEs weakened. Those entities could no longer absorb losses the way they were designed to. Obligations started flowing back onto Enron's balance sheet, the very place they had been hidden from. Losses that had been deferred suddenly demanded recognition. On October 16, 2001, the company announced that $1.2 billion in shareholder equity would be reduced. For most viewers, it sounded technical. Adjustments, reclassifications, complex accounting language. But inside the system, it was something else. It was gravity returning. A few days later, during a conference call, an analyst pressed for clarity on these off-balance sheet structures. The response from leadership was not explanation, it was irritation. The question itself was treated as the problem. That moment mattered more than the number. Because it revealed something the market had not yet priced in, the company could no longer maintain the story. Confidence began to fracture. Credit agencies moved. Counterparties hesitated. Trading partners demanded more collateral. Liquidity tightened. And once trust starts to withdraw, it does not leave gradually. It leaves all at once. By early December 2001, Enron filed for bankruptcy, not because it suddenly became unprofitable, but because the system it built could no longer hide the difference between what it claimed to earn and what it could actually pay. When Enron collapsed, the numbers didn't disappear. They were exposed, and the people who trusted those numbers paid the price. At the peak, Enron employees were encouraged, sometimes quietly pressured to hold company stock inside their retirement plans. For many, it wasn't just an investment. It was their savings, their future, their exit after decades of work. In late 2001, while executives were selling shares, employees were locked out of their retirement accounts during a system transition. They couldn't sell. They couldn't hedge. They could only watch. Imagine you are a 52-year-old operations manager in Houston. You spent 20 years inside the company. Your 401k is heavily concentrated in Enron stock because that's what the company culture rewarded. In January, your account shows $800,000. By November, it's worth less than $10,000. Nothing in your daily life prepared you for that speed. The office still looks the same. Your badge still works. But your future has already been erased. This is the difference between nominal wealth and usable wealth. On paper, Enron created billions in profit. Executives received bonuses, stock options, and public recognition. The company was named Most Innovative 6 years in a row. But that wealth depended on assumptions. It depended on models. It depended on a stock price that could not fall. When the system broke, that paper wealth vanished almost instantly. But the consequences did not distribute evenly. Senior executives had already sold significant portions of their holdings before the collapse. Compensation structures rewarded reported earnings, not cash generation. By the time losses surfaced, many of the architects had already secured their gains. Meanwhile, employees, pension funds, and ordinary shareholders absorbed the damage, not because they were reckless, but because they trusted the signals. They trusted audited financial statements. They trusted consistent earnings growth. They trusted that profit meant money was actually being made. What they were really trusting was a system that allowed future assumptions to be treated as present reality. And when that illusion broke, there was no mechanism to reverse the damage, because the money had never been there to begin with. This is how financial systems fail in practice, not with explosions, but with quiet transfers from those who believe the numbers to those who understand how they are constructed. There is a reason Enron's story still matters, not because the fraud was unique, but because the mechanism was legal until it wasn't. Mark-to-market accounting still exists. Complex financial structures still exist. Incentives to accelerate profit and delay loss still exist. The surface has changed. The pattern has not. So the question becomes practical. If profits can be modeled, if earnings can be smoothed, if balance sheets can be rearranged, what can't be manipulated for long? Cash flow, not reported profit, not adjusted earnings, not forward-looking guidance. Cash, specifically cash flow from operations. This is the line that tracks whether a company is actually generating money from its core business after all the models, assumptions, and accounting treatments are applied. And here is the signal that matters. When a company consistently reports rising profits, but its operating cash flow does not follow the same trajectory, a gap begins to form. At first, it looks harmless. Then it widens. Eventually, it becomes impossible to hide. This is not a prediction tool. It will not tell you when the system will fail, but it will show you when the underlying engine is no longer aligned with the story being told. There are exceptions. Timing differences exist. Some industries naturally show temporary gaps, but persistent divergence is rarely accidental. It is usually structural. So the protocol is simple. When you evaluate any company, do not start with earnings. Start with cash. Ask one question. Is the business actually receiving money at the same rate it claims to be earning it? If the answer is yes, the system may be intact. If the answer is no, then you are no longer analyzing performance. You are analyzing a narrative. And at that point, you have a decision to make. Trust the story or follow the money.